There is a rule in Nigeria that almost nobody has heard. Every month, about 11 million Nigerians have money taken from their pay and set aside for old age. It all goes into a national pot. Right now, that pot holds 31 trillion naira, around $22 billion. That money doesn't sit still. The people looking after that money lends it out so that it grows. You see, when a company needs money, it can borrow from ordinary savers instead of a bank. It writes a promise: give me money now, I'll pay you back later with extra on top. That promise is called a bond. Anyone can buy one. Now, nobody can take the savings of 11 million people and just hand it over to a company based on promise alone. Now, let me introduce you to the rule governing these kind of practices. Before a company's promise can be sold to that pot, it has to be graded a safety score, minimum grade A, and not from one grader, from two, both licensed by the government. Nigeria has 3 licensed graders, 3, Agusto and Company, GCR, and Data Pro. Now, 2 of those 3 companies I just talked about are no longer Nigerian owned. Nobody voted for it. There was no announcement, and most Nigerians don't even know that change has occurred. The most recent handover was in New York on the 28th of July 2026. S&P Global, one of the biggest companies that grade borrowing on earth, agreed to buy control of Agusto and Company, a Lagos firm founded in 1992, grading borrowers in Nigeria, Kenya, Rwanda and Ghana. Now, the price wasn't made public, and the deal still needs permission or approval from regulators from all 4 countries, the 4 countries we just talked about. To be clear, this is very important. S&P doesn't lend money. It can't approve a loan or even block one. What it does is set the price. Now, say 2 companies wants to borrow the same amount, the same money on the same day for the same thing. The company with a higher grade might pay 8% a year. The one with a lower grade pays 15%. That is the same money, but very different cost, and it is the grade that decided those percentages. In Nigeria, the grade does more than that. Without an A grade from 2 graders, the retirement pot, that is the pot we talked earlier about at the beginning of this video, that keeps the money of 11 million Nigerians, that is about $22 billion US. If you don't have an A grade from these graders, the pot is not allowed to lend to you at all, however good your business is. Now, S&P already grades Nigeria. 10 weeks before this deal, in May, it raised Nigeria's grade. It already ran Nigerian grade scale and raised that too. And look at the size difference. Nigeria's whole retirement pot is $20 billion US. That same year, S&P planned to hand $7 billion back to its own shareholders. So what does a company that size want from a firm that small? That's the question I couldn't get past. You see, the answer starts with something that has been changing quietly for years. Africa's borrowing has been coming home. Now, most of it happens at home in local money. Naira, cedi, shilling, CFA franc. Roughly 60% of African government debt that can be traded is now in African currencies. Senegal shows why that matters. In 2025, Senegal borrowed over $5 billion from lenders in its own West African neighborhood. It paid about 7% interest. Borrowing dollars abroad would have cost it more than 10%. Senegal went to the market 5 times that year, and every single time, more lenders showed up with money than Senegal had asked to borrow. It had to turn people away. Now, remember, it comes back. Meanwhile, African savings are piling up with nowhere good to go. Nigeria's retirement pot has grown 51% in 2 years, but more than half of it just sits in loans to the Nigerian government because that's the safest thing on offer. In July, the regulator admitted it. There isn't enough good stuff to lend to, so somebody has to hand out the safety grades. That's a business. Now, here is the machinery you need. There are 2 ways to grade a borrower. The first method compares them to every borrower on earth. Now, on that scale, even the very well-known Nigerian bank can't score much above the Nigerian government itself. If the government stops paying its debts, that bank usually goes down with it. That limit has a name. It's called the sovereign ceiling. Now, the second method of grading a borrower asks a similar question. Out of everyone borrowing naira inside Nigeria, who is safest? So the same bank walks away with two different grades on the same day. Low on one scale, high on the other. Neither grade is wrong. They were answering two different questions. The second kind of grade, the one that only measures you against your own country, was built in Africa. A South African firm called GCR started it here. Agusto has been doing it in Lagos since 2001 and has handed out more than 4,000 grades to Nigerian banks, companies, and insurers. So the answer was obvious. S&P bought a tool it didn't have. Except it did have. S&P runs a Nigerian scale. It used it in May. So what exactly did it buy? What was for sale wasn't a method. It was 4 government licenses in 4 different countries, a list of paying customers, 34 years of records on who in Nigeria pays their debts and who doesn't, and the staff who live there. African governments have complained for years that these companies judge the continent from far away. One study found Moody's, covering all 28 African countries, it graded from a single office in South Africa. Then there is the empty space. By the African Union's own count, about 40% of African governments have never been graded. For African companies and city governments, it's over 90%. Every one of them is a company that has never paid a grader anything. And here is the part that makes this a good business. The grader does not charge once and walk away. It charges a fee every year for as long as the loan is still running, to keep the checking whether the borrower is still safe. So there it is. Wall Street arrives in Africa in 2026. Except that's not when it arrived. February 2022, Moody's buys 51% of GCR, the biggest grading firm based in Africa. July 2024, it buys the rest. GCR had already swallowed WARA, the West Africa Rating Agency, in 2021. That handed Moody's the French-speaking countries. August 2025, Moody's moves to take control of Mauritius in Egypt. English-speaking Africa, French-speaking Africa, North Africa. 3 purchases in 4 years, 1 company. S&P isn't first here, it's second, and it is late. Now back to those 3 names we talked earlier. Agusto being bought by S&P. GCR owned outright by Moody's since 2024. Data Pro still Nigerian. 2 of 3 doors into 11 million people's retirement savings held in New York. The rule demanding 2 grades was built to protect workers. It also built a toll booth that collects forever, and the booths were sold. Now, Senegal comes back. Senegal did the thing African leaders have been asking for years. It borrowed at home, cheaply, and lenders queued up. In late October 2025, Moody's lowered Senegal's grade, 3rd time in a year. The reason given was that leaning on its neighbours left Senegal exposed if those neighbours changed their mind. Now S&P looked at exactly the same thing Senegal had done and reached the opposite conclusion. It called that borrowing a sign of strength. But Moody's is the bigger name, so when the grade came down, lenders panicked and rushed to sell whatever Senegal debt they were holding. And when everyone sells at once, the price falls. One Senegalese loan had promised to pay back a full $1. People were selling it for 40 cents just to get out. By February 2026, the African Union's own economist had published a formal request. Stop treating borrowing at home as a warning sign. That's where I expected the story to end. Foreign graders, unfair scores, Africa punished for doing the right thing. But check that against the evidence and it gets complicated. In July 2025, the IMF studied this exact question. Once you account for how a country is actually run and what shape its finances are in, it's found limited evidence the graders treat Africa unfairly. Now, in calm times, African governments pay about half a percentage point extra. In a crisis, that roughly doubles. Chatham House points to Moody's own records. African governments fail to repay at the same rate as similarly graded countries elsewhere, and much of the pain came from somewhere else. The interest rate on American government debt jumped almost 3 percentage points in 3 years. When lending to America pays that much better, lending to everyone else gets dearer. That's Washington, not an analyst's opinion. There is also a failure made in Africa. In Senegal, around $11 billion of government debt, roughly a third of the whole economy, only came to light after a new government took over. Lenders who worry about hidden debt aren't being unreasonable. Even the famous lumber wobbles, the figure quoted everywhere is $74.5 billion from a UN study in 2022. Brookings, who helped launch it, calls that a loss, adding up across many loans over many years. The African Union's own review body calls the same study $74.5 billion lost every single year. Same number, two different claims. Then a detail that stayed with me. In 2022, when Moody's bought CGR, an analysis warned it was a serious setback for building African alternatives. In July 2026, when S&P announced the Agusto deal, Dr. Mishek Mutize, the African Union's lead expert on grading firms, told CNBC Africa, "We seem to be vindicated that we were raising legitimate concerns. Africa has its own answer coming." The African Union approved a continental grading agency, AfCRA, based in Mauritius, no government ownership. It opens on the 6th of October, starting with borrowing in African currencies, which is the same corner of the African market Moody's and S&P have spent 4 years buying into. Its opening date has already moved 5 times, and no list of its owners have been made public for an agency whose whole pitch is independence. There is a precedent for what comes next. It isn't African. In 1997, S&P bought a small piece of CRISIL, India's grading firm. In 2005, it took control. Today, CRISIL still carries its own name, still hands out its own grades and employs thousands. It's also still controlled by S&P 21 years later. And in 2017, CRISIL bought into the last big Indian grader with no link to the big three. Now, both things happened. The local firm thrived. The local industry ended up foreign-owned. Now, the Agusto deal isn't done. It needs permission from regulators in Nigeria, Kenya, Rwanda and Ghana. Each must decide whether this change fits its own rules on keeping graders independent. 4 African regulators can say yes or say no. As of late August, none has said anything in public. So, back to the rule: 2 grades, 3 firms, 11 million workers. What did S&P buy? Not the power to decide which African countries get money. It bought a license seat at the gate that Nigerian law itself built, standing between Nigerian companies and Nigerian workers' savings. And it bought it 4 years after a rival bought a bigger one. Now, here is what I keep coming back to. The IMF says 2 things drive what Africa pays to borrow: American interest rates and how honest African governments are about their debts. If that's right, then who owns the grading firms matters much less than either side of this argument wants to admit. So the price may not be the real price. What's being bought and sold is who gets to hand out the grades. That's worth something. Right now, it's worth it mostly to the owners. But look at why these gates were worth buying at all. Africans now have money to lend to each other. 31 trillion naira sitting in one Nigerian pot. Pension savings in Ghana, in Kenya, in South Africa. Lenders in Dakar who fired Senegal's order 5 times over. Nobody buys a toll gate on a road that carries nothing. You see, control in finance doesn't live in speeches. It lives in a paragraph, in a pension rulebook, in who holds a license, in whether anyone checks who buys whom. 4 permission letters are sitting on 4 desks right now. That's this month's question. The longer one is whether the next set of gates gets built in Africa or bought from Africa. I'll see you in my next video. Bye.